Stacks is the leading smart contracts platform for Bitcoin. And with BTC going what appears to be parabolic off the back of the Bitcoin spot ETF inflows, the STX token has returned to all-time highs and could just be one of the best altcoins to hold from a risk-reward perspective going into a potential post-halving bull run. Now in this video, I'm going to dive into Stacks and its quest to build a decentralized economy on top of Bitcoin. I'll explain Stacks' technology, its lofty goals to extend Bitcoin's functionality with fully expressive smart contracts, the major milestones that the project has hit so far, what's ahead with the Nakamoto and sBTC hard forks. I'll compare Stacks to other Bitcoin L2s such as Lightning, and we'll contrast the difference between Bitcoin L2s and Ethereum L2s more broadly. And of course, we'll dive into some price projections under a range of scenarios. In a nutshell, Stacks, a decade-old project now, they kicked off in Princeton's computer science department, grabs Bitcoin's strengths and aims to bring all the fancy bells and whistles of other L1s, unlocking the world of DeFi, NFTs, Web3 on the world's biggest blockchain. And this especially matters right now because as an altcoin investment, when the overriding narrative is Bitcoin, then having exposure to Bitcoin picks and shovels infrastructure projects like Stacks might just be one of the best ways to ride that narrative, outperform Bitcoin itself, and somewhat hedge yourself against broader macro risks. There's a lot to talk about, so let's dive in. Alright, what is Stacks? Well, to understand Stacks, we have to first understand the limitations and therefore the opportunities for Bitcoin. Now, Bitcoin was initially designed to be a secure and decentralized payment system, but that focused on security and decentralization means it suffers from scalability problems, right? That has prevented its widespread adoption so far for those use cases. Now, by scalability, I mean speed, finality, and throughput. So Bitcoin adds a new block onto the Bitcoin blockchain every 10 minutes. It then takes another 5 blocks to confirm that original block, meaning transactions take up to an hour to be finalized. Now that kind of speed and finality is a far cry from what's needed for a payment system, a global payment system that can compete with, say, Visa. Users simply have to wait too long for transactions to go through. And then there's throughput, how quickly the network can churn through transactions, which determines how far Bitcoin can scale as a network. Now, a standard Bitcoin block can carry 1 megabyte worth of transactions, technically up to 4 megabytes in theory after the segregated witness and taproot upgrades. Now, a transaction on Bitcoin takes up between 220 to about 500 bytes. So that means a standard 1 meg block can pack in around 2,000 to 4,400 transactions. Now, that might seem like a lot, but remember, Bitcoin mints a new block only every 10 minutes. So 4,400 transactions every 10 minutes, that actually works out to be up to around 7 transactions per second, right? In fact, Bitcoin averages around 5 transactions per second. So in short, Bitcoin, it can't handle many transactions, and the transactions themselves do take a little while to settle. The second limitation is, well, no smart contracts. And that's why Ethereum came about, right? No smart contracts on Bitcoin means no decentralized finance, no NFTs, which serve as the vehicle for the ownership of unique assets on blockchain technology, no decentralized internet, aka Web3. What's challenging is that Bitcoin's base layer was never designed for smart contracts and decentralized apps. Bitcoin was designed specifically for peer-to-peer digital payments, but in the 15 years since Bitcoin entered the world, DeFi, NFTs, Web3 has become really important use cases for blockchain technology. And hey, this is where Stacks comes in, and our decade-old project, which in its current form is a layer 2 blockchain sitting on top of Bitcoin. And the promise is developers can build smart contracts and Web3 apps on the Stacks blockchain using its Clarity programming language. And these dApps can then use Bitcoin as simply as a settlement layer, right? Which means being able to leverage Bitcoin security, capital, and network effects. And that's a lot of latent value to be unlocked because Stacks makes or $1 trillion worth of Bitcoin programmable through smart contracts. And so suddenly the properties that make Bitcoin powerful as a store of value can be extended to other aspects of value settlement on our digital lives, such as decentralized finance, DeFi, NFTs, Web3, essentially a decentralized user-owned internet that's built on and secured by Bitcoin. And here's a list of projects building on the Stacks blockchain. It's quite a lot. All right, so that's the value prop. Now let's dive into the history of the project, the main developments, and most importantly, where it's heading into the future, which is going to help you understand why Stacks is such a popular picks and shovels investment for Bitcoin. All right, early days. So Stacks began as in a different name, Blockstack, which was founded in 2013, a decade ago, by two PhD students at Princeton's computer science department, Munib Ali and Ryan Shea. Now these lads believed that the internet, which actually started off decentralized, had become broken, right, with data and power consolidating in the hands of large tech companies. Users were forced to essentially blindly trust companies like Google, Amazon, Facebook to do the right thing with their personal information, and data was stored in giant data centers that were vulnerable to hackers. And they had a point, looking at the Snowden leaks that revealed how the NSA essentially strong-armed Microsoft into handing over users' personal data without obtaining court-issued warrants. At the 2017 Consensus Conference, Munib said something pretty interesting that kind of sums up what Blockstack was trying to address.
Google has this saying, don't be evil. Maybe a company shouldn't be powerful enough that they're sitting there thinking, should I be evil or not?
Very interesting. Google has a saying, don't be evil. Maybe a company shouldn't be powerful enough that they're sitting there thinking, should I be evil or not? In other words, companies shouldn't be allowed to grow this powerful, right? So how do we decentralize the internet again? Rebuild it so that individuals can reclaim direct control over their personal identities, over who they know, their contacts, over their valuable data. Well, it turns out these guys found a way to, I guess you can say, reorganize cloud computing by kind of breaking up internet data centers into virtual storage lockers that are fully encrypted so that even when your data is technically still sitting in Google Cloud, Microsoft Azure, Amazon Web Services, individual users hold the keys to their own data, and so that only they can control who can access it.
So if you're a Dropbox engineer, you can actually go through all of my files today. But the way Blockstack works, when I use Dropbox, again the same service, but through Blockstack, their engineers have no visibility into the encrypted blobs of data that is actually being stored there. It doesn't matter if it's provided by Dropbox or Google or Amazon, they're being reduced to these like dumb hard drives that just stored encrypted data.
So in other words, forget about doing away with centralized big tech platforms, cloud platforms like GCP, Azure, AWS. They're a necessary evil, so to speak, but we don't have to do away with them, right? There is a way to use these global cloud providers, yet still retain your privacy and keep your data safe. Now, if you're interested in the more technical details, I'd urge you to check out the Blockstack initial 2017 white paper, which I'll link down in the descriptions below. Now, this seminal document dived into three main things. Number one, the initial design of the Blockstack blockchain, which is built using something called Virtualchains. Now, this works in a similar way to virtual machines for normal computers. Number two, a network called Atlas, which essentially helps computers find where decentralized data is stored. And this ties into number three, which is the Gaia decentralized storage system, which enables Blockstack to securely store your data without the need for any new centralized middleman, helping internet users regain power over their privacy, their data. Now, you'll notice that this is a very serious attempt by some very smart people to fix some serious centralization issues that exist in Web 2, and they had spent 2, 3, 4 years developing a suite of new technologies to help make this happen. Now, the Blockstack blockchain launched its mainnet in January 2018. Now, nowadays this is referred to as Stacks 1.0. Now, this early version of the Stacks blockchain relied on Virtualchains, which leveraged Bitcoin's own consensus mechanism to keep the wheels turning, and actually allow developers to write and deploy virtualized smart contracts on top of Bitcoin using Bitcoin's somewhat ad hoc and primitive scripting language. Now, this was already a leap forward for bringing smart contracts onto Bitcoin, but like trying to give a speech in a language you're not too fluent in.
我不知道关于老干妈，但是中国人说这是非常好的 chili sauce.
There were limitations, right? The smart contracts weren't that powerful or expressive compared to the smart contracts of our contemporary peers. So this is why Ethereum came around, right? It was designed to be a smart contracts platform off the bat, a world computer, a decentralized AWS, if you will. Now, in Q3 of 2019, Bitcoin held its initial coin offering, raising over $50 million across several rounds, providing the team with a multi-year runway to build out its vision of a decentralized parallel internet. Now, the project also got some notable VC backing, including Union Square, Lux, Winklevoss, Digital Currency Group, and Kazar Yunus, who was the chief operating officer for Y Combinator. Now, what's notable about the ICO was that it was the first ever SEC essentially approved ICO, right? Munib Ali and the Blockstack team decided to go the hard route, essentially playing by the books and actually working with US regulators to figure out a legal framework for the Stacks token, therefore opening up the ICO to the general public without having to exclude Americans. Now, this is a fine example of crypto companies working together with entities traditionally seen to impede the progress of the crypto and Web3 industry. Another recent example of this is the team behind STEPN, who pulled off a bonanza of a partnership with Apple that saw Apple Pay become integrated into the STEPN walking app, allowing users to easily use fiat to directly buy NFT shoes and start earning money exercising every day. Now, these kinds of, dare I say, pioneering partnerships, right? Stacks with the SEC, STEPN with Apple, there are other examples, are pretty hard to pull off, but can pay off big time, not just for themselves, the individual projects, but set precedents for the entire crypto industry. Now, in October 2020, Blockstack rebranded itself to Stacks to better align with where the project was going. Now, rebranding while a project is in full flight and growing is it's a painful exercise no matter how you put it. So why did the team think this was necessary? Well, firstly, Stacks, being the name of the token itself, is an instantly recognizable brand that the whole community can get behind. And community here really was the key, right? Blockstack, or more accurately, the company Blockstack PBC, headed by Munib Ali, really represented a single company whose focus was building the blockchain. But by 2020, the Blockstack blockchain had spurred a global ecosystem of builders contributing towards the Blockstack ecosystem. And so to capture this ecosystem-focused ethos, Blockstack PBC renamed itself to Hero. Kind of a random name, but it no longer has the word Blockstack in it. Hero is just one company within the blockchain ecosystem, right? And the blockchain itself was rebranded as Stacks, which, as I mentioned earlier, has instant marketing appeal. It's the name of the token, right? Nice and simple. And look, if this kind of blockchain branding structure confuses you, another good example is Cardano. Right? Cardano is the blockchain, but it's developed by the company IOHK, which doesn't have the name Cardano anywhere in it. Right? This is to help separate the company that builds the blockchain from the ecosystem that ends up flourishing from that blockchain, right? Because once that chain begins taking off and starts attracting users, builders and dApps from around the world, you do want to keep those things separate for the benefit of the ecosystem. All right, now speaking of ecosystems and dApps, this brings me to the major Stacks 2.0 upgrade that went live in January 2020, just as the COVID-19 pandemic was about to sweep the world. Now, this was a major update introducing a host of new stuff, but the two big ones relate to smart contracts functionality and some big updates to the consensus mechanism for Stacks. Now, while I give a brief overview of what Stacks 2.0 brought to the table, I will play this launch video in the background so we can see Munib's beautiful face and have some pretty slides related to Stacks 2.0 to look at. I'll link the video in the descriptions down below if you want to check it out later. All right, so first up, Stacks 2.0 brought clarity smart contracts. Now, this is doing away with the old Bitcoin scripting language for hacking together smart contracts. Stacks 2.0 introduced clarity, a new programming language specifically designed for writing smart contracts on the Stacks blockchain. Now, Clarity offered enhanced security and predictability by enabling developers to write code that was easier to audit, easier to understand. And this helps drive developer adoption and better and safer dApps on Stacks, which is crucial for attracting builders and users onto the chain. So in short, Stacks was a major upgrade for smart contracts capability, opening up developers to build their own dApps that settle on Bitcoin, a major step forward for establishing a vibrant DeFi, NFT, and Web3 scene on the Bitcoin blockchain. Next up, consensus. Stacks 2.0 introduced the proof of transfer, POX, consensus mechanism. Now here's a brief rundown of how it works. It is pretty interesting. So first up, we know that Bitcoin's consensus mechanism revolves around proof of work, right? Where miners compete to add new Bitcoin blocks by doing work, which really means spending money on electricity to power computers to solve essentially very taxing mathematical puzzles. Blocks are then finalized using the longest chain rule. Now that's Bitcoin's consensus in a nutshell, proof of work plus the longest chain rule, right? And as you may have heard, it's not great for the environment, and this is one of Bitcoin's common criticisms. So what Stacks did was say, hey, Bitcoin that's already mined essentially represent mining power, right? So why don't we leverage that? There's no need to reinvent the wheel. Let's acknowledge and take advantage of all of that hard work that has already been done to crank out those Bitcoin blocks that exist today, right? And we simply get Stacks miners to commit their own Bitcoin to earn the right to mine new blocks on the Stacks blockchain. So this is kind of similar to how stakers commit their proof of stake cryptocurrencies, like Ether, like Sol, to secure the network and mint new blocks on Ethereum, on Solana. But the difference is on Stacks, miners commit one cryptocurrency, it's Bitcoin, and earn another one, right, which is Stacks, right? And this is where the name proof of transfer comes from. By locking up your BTC in order to mine STX, miners have transferred the value from Bitcoin to the Stacks blockchain. Now, what about all that locked away Bitcoin, right? Does someone get it? Is that Bitcoin burnt? And this brings me to the idea of stackers, which is kind of like ordinary staking on Stacks. So basically you and I, we can buy STX tokens and we can stack them, essentially commit them for a length of time like staking, and earn that Bitcoin that the miners have committed. And so what that means is proof of transfer is actually a bit of an evolution of what's known as the proof of burn consensus mechanism, where miners burn cryptocurrencies to earn the right to mine new blocks. Now on Stacks, the Bitcoin that miners commit isn't actually burnt, it's transferred. The value is transferred onto the Stacks blockchain itself, where miners are basically locking away their own Bitcoin to mine STX, and then that Bitcoin itself, rather than being burnt, is transferred quite literally into the hands, wallets, of STX stackers. So in a nutshell, Stacks 2.0, you got a new proof of transfer consensus mechanism, which anchors the Stacks blockchain to Bitcoin, right? Whereby the state of Stacks, basically all the current balances of every Stacks address and the state of all Stacks smart contracts, is recorded onto the Bitcoin blockchain in a way that's cryptographically secure and it's immutable, right? In other words, things happen on Stacks and it's ultimately settled on Bitcoin, which is extremely decentralized and secure. That's the whole idea. And from an incentives perspective, miners commit Bitcoin to mint Stacks blocks and earn STX tokens. And that Bitcoin can be earned by stackers who commit their own STX tokens. And finally, from a builder's perspective, you've got Clarity smart contracts, right? Builders can now launch dApps on Stacks that actually settle on Bitcoin, taking advantage of Bitcoin's unparalleled security, decentralization, capital, and network effects. All right, so what's coming ahead for Stacks? Well, it's a lot. And this is a very important question for a whole range of stakeholders, the Bitcoin believers, the DeFi, NFTs, and Web3 believers and users, particularly those who want a Web3 scene on Bitcoin. Right. The Stacks builders, the Stacks users, and of course, the investors and speculators who are holders of Bitcoin and Stacks. Well, in 2024, there are two major and long-awaited updates coming. Nakamoto, which will coincide with the Bitcoin halving, and sBTC. Both upgrades were initially meant to happen together, but now Nakamoto is going to be rolled out first with sBTC shortly afterwards. Now, focusing on Nakamoto first, this hard fork is going to introduce three main performance and security related upgrades to the Stacks blockchain. First, we're going to get something called fast blocks. Now, these are produced every 5 seconds. So for users, this is much faster block production compared to Bitcoin's 10-minute block time, means way faster transaction confirmations, making the user experience closer to that of, well, that Visa-like experience for financial transactions and Solana-like experience for those enjoying DeFi, NFTs, and Web3 in the Solana scene. That's the aim. A whole bunch of these fast blocks then get settled on Bitcoin in the background every 10 minutes. Second, we're going to get Bitcoin finality on Stacks. So to put it another way, once a transaction on Stacks is confirmed, reversing that transaction is going to be at least as hard as reversing a Bitcoin transaction, which is very, very, very hard. Third, we're going to get something called MEV resistance. Now, MEV stands for maximal extractable value, and it's something usually associated with Ethereum, so the way it works is this, whereas as pending transactions sit in a mempool waiting to be picked up, right? So if you try and swap tokens on Uniswap, if you submit some sort of transaction, right, and you're waiting for it to go through, validators have actually found ways to make extra profit from rearranging the order of transactions. So this wonky MEV phenomena is known to be a bit of a, I guess you can say, invisible tax on users. Right, not great. Kind of reminds me of taxi drivers picking and choosing who they want to pick up at the airport, right? But it is what it is, and the issue exists on Bitcoin as well. It's just not as lucrative as it is on Ethereum. Well, the short story is Nakamoto, right, this hard fork is going to tinker with some of the sorting algorithms on Stacks so that Bitcoin miners don't have an advantage as Stacks miners, basically making Stacks resistant to this MEV shenanigans. All right, so that's the Nakamoto hard fork in a nutshell, right? The upgrade is slated for April 2024. It's going to coincide with the halving, roughly. Very interesting, introduces a bunch of performance and security updates. Next up, we have the sBTC hard fork. Now, in my opinion, this is the most interesting upgrade. It's a bit more of a technical one to explain, but the outcome is the ability to finally have what the Stacks team calls fully expressive smart contracts on Bitcoin, like those we can see on Ethereum level 2s like Arbitrum, Optimism, and sidechains like Polygon POS. Now, by fully expressive, the team means smart contracts that can perform a broad range of operations, computations, interactions on the blockchain autonomously without requiring centralized control. And you need these sorts of powerful smart contracts for more advanced use cases. So for example, in DeFi, sBTC means you can trustlessly deploy your Bitcoin to earn Bitcoin yield, right? sBTC will mean it will enable trustless Bitcoin collateralized stablecoin loans, which lets you tap into your Bitcoin for liquidity without having to sell it, right? sBTC will unlock on-chain under-collateralized Bitcoin lending. Now, this is something you can do off-chain on a centralized exchange like Binance, right? Taking out loans like this. But it's been the goal of DeFi for the longest time to bring these sorts of CeFi-like experience to DeFi. And Solana has been really good at that so far. There are more examples. It'll make Bitcoin DAOs a bit easier. You can leverage Bitcoin for NFTs. I'll talk more about Ordinals shortly. They're a little bit different. sBTC also has implications for payments on Bitcoin, something that Lightning is currently the top dog at, and I'll talk more about Lightning shortly as well. So sBTC is crucial for enabling Stacks to achieve its core goal of building that decentralized economy on top of Bitcoin. But what exactly is sBTC? So I'll do a brief dive into the technical details, and in a nutshell, it's a suite of technical innovations that the Stacks team has had to invent. It's a set of hurdles that the team has had to overcome in order to get fully expressive smart contracts to work on Bitcoin, a chain that ultimately was not designed for smart contracts at all. Okay, so sBTC, it stands for Stacks BTC, right? Probably no surprises there. It's essentially Bitcoin represented on Stacks. And the sBTC hard fork introduces what's known as a two-way peg system that enables Bitcoin to essentially be bridged between Stacks as a layer 2 and the underlying Bitcoin blockchain in a decentralized manner while having the transaction 100% secured on Bitcoin. So sBTC as a piece of technology is essentially what's called a decentralized Bitcoin peg. Now, what does that mean exactly, and what's so special about it, right? Isn't this just a bridge that allows you to move Bitcoin between the base layer and Stacks, right? Bridges have been around for years on Ethereum, right? What's so special about this bridge? And what does the decentralized Bitcoin peg mean as well? And why is that important? So the first thing to appreciate is that L2s on Ethereum are used for scalability. That's why they exist. That's about it, right? Well, on Bitcoin, any L2 that's designed to support additional smart contracts capability have to do way more of the heavy lifting given the limited functionality of the Bitcoin base layer. And the biggest challenge preventing Bitcoin from becoming more like Ethereum as a smart contracts powerhouse is essentially being able to move Bitcoin out of the base layer into an L2 in a secure and decentralized manner. And that's because the Bitcoin base layer can't really support smart contracts. It just wasn't part of Bitcoin's design, right? So to use Bitcoin in a Web3 app, for instance, users have to first deposit or peg in their Bitcoin onto an L2 that does offer fully expressive smart contracts, get a synthetic version of that Bitcoin, which can then be used in said Web3 app. And here's the crux. The fundamental problem with all Bitcoin pegs so far is that they are not decentralized, right? They need a custodian to process the peg out that send the BTC back to your Bitcoin wallet when you're done on the L2. And so this is where Stacks' sBTC two-way peg system comes in. In peg-in mode, which you can informally think of as bridging Bitcoin onto the L2 Stacks blockchain, users send BTC to a peg wallet on the Bitcoin chain that's controlled by a threshold number of stackers that's determined by the fraction of locked STX that they represent. In peg out mode, right, it's this threshold number of stackers that carries out any bridging out request by users by transferring the Bitcoin from the peg wallet to the desired Bitcoin address. So stackers, which are kind of like stakers in a proof of stake blockchain, they actually serve a really important role in securing the Stacks blockchain, right? When you spend your hard-earned money on STX tokens, not financial advice, and you stack them to earn a yield, you're actually helping to carry out decentralized peg out requests. Very, very important. So all up, the sBTC two-way peg system essentially solves what's called the Bitcoin write problem. Right, this is a long-standing problem of how to write Bitcoin transactions onto the Bitcoin blockchain in a fully decentralized manner. This is the approach the Stacks team has come up with, sBTC, right? And it's that missing piece of the puzzle to make Stacks a fully featured smart contracts platform. Now, the team believes that this innovation is going to unlock hundreds of billions of dollars of latent Bitcoin capital to create that Bitcoin app economy that's going to rival and perhaps even surpass the ecosystems of other blockchains, right? This is a major step forward, no doubt, for enabling a vibrant DeFi, NFT, and Web3 scene on Bitcoin. All right, now speaking of NFTs on Bitcoin, so out of completeness, I should briefly cover Bitcoin Ordinals and Ordinal Inscriptions, which are sometimes called Bitcoin NFTs, even though they are quite different to traditional NFTs like those you see on Ethereum, Solana, Polygon, and other chains. All right, so how does it all work? So the Bitcoin Ordinals protocol, this was launched in early 2023 by a fellow called Casey Rodimer. Right now, what the protocol does, and it's quite ingenious actually, it's quite clever, is that it allows users to assign a unique identifier to each Satoshi. Right now, Satoshi is the smallest unit of Bitcoin. So as a result, Satoshis then become trackable units, which are then called ordinals. That's what they are. Right. Now, this protocol maintains a record of the transaction history for each ordinal, and you can then inscribe content into these ordinals. So it's like grabbing a Sharpie, a digital pen, a digital Sharpie, right, and inscribing your own data onto the tiniest pieces of Bitcoin. Now, what really made this protocol quite useful was that was the Bitcoin Taproot and SegWit upgrades, which bumped the Bitcoin block size up to 4 megabytes. Right now, that means that you can inscribe images, GIFs into ordinals. So suddenly, a whole bunch of useful data types can now squeeze into these tracked Satoshis, these ordinals. And so, for all intents and purposes, these trackable data holding Satoshis are effectively NFTs on the Bitcoin blockchain. Look, the implementation is different to how NFTs work on Ethereum and other chains, but ultimately Bitcoin NFTs are still NFTs, I would argue, because, well, on a philosophical level, NFTs can simply be thought of as the vehicle to provide verifiable, decentralized ownership. It's how you store unique things on the blockchain, right? NFTs are ultimately just unique digital assets sitting on the chain, right? There are different ways for engineers to implement that from a technological standpoint. So ERC 721 tokens on Ethereum, that's one way. Bitcoin Ordinals is another way, right? They both achieve the goal of verifiable decentralized ownership, even if the technology and capabilities are a little bit different. Now, just out of interest, some interesting Bitcoin collections, Bitcoin Ordinal collection, include Bitcoin Shrooms. So this was, I believe, the first Ordinals collection. Ordinal Punks. So this is an ode to the iconic crypto punks. Taproot Wizards. 2 words, Taproot and Wizard, actually represents, it's an ode to both the Bitcoin Taproot upgrade that helped make Ordinals possible in the first place, and also a famous Bitcoin meme from 2013, right? So something old, something new, I guess you can say. Bitcoin DeGods, right? Famous collection launched on Solana that's now on multiple chains, including Bitcoin. And Bitcoin and Ordinal Loops, right, which showcases the sequential ordinal numbers in a loop. It's very interesting. If there's enough interest, I might do a whole video on ordinals. Now, what's the relationship between ordinals and stacks? So from a technology standpoint, there's a good amount of difference, right? Ordinals is a layer 1 protocol for numbering Satoshis. Stacks is a layer 2 that allows developers to build native NFTs similar to those on Ethereum and other chains. But from a business and user adoption perspective, Ordinals came at a really great time, right? Shining the spotlight on the potential of a vibrant NFT scene on Bitcoin, which plays hand in hand with the capabilities that Stacks is trying to build out. In fact, Stacks rallied 50% in early 2023, pretty much because of the hype surrounding Ordinals, right? Investors were essentially thinking, look, if a quirky roundabout way to inscribe data to trackable Satoshis, to basically get NFTs on Bitcoin, is showing this much potential, right? Imagine the possibilities when builders can develop NFTs and Web3 projects on Bitcoin through the Stacks blockchain in a much more proper or streamlined way. Right. All right, so that's a preview of what's ahead for Stacks. A lot of exciting stuff. All right, zooming out a bit now, where does Stacks fit in the world of scaling solutions? So I'll give a brief 30,000 feet overview, and I want to touch on 5 interrelated things. Number 1, what's the difference between on-chain and off-chain scaling? Number 2, some important differences between Bitcoin and Ethereum scaling solutions. Number 3, what kind of scaling solution is Stacks exactly? Right, is it on-chain, L1? Is it off-chain? Is it L2? Is it a sidechain? Hint, there's a reason why the team prefers to simply call Stacks a Bitcoin layer, right? Because there's no clean answer, unfortunately. Number 4, how does Stacks compare against other Bitcoin layers like Lightning, Rootstack, and Liquid? And finally, understanding all of this is going to allow us to have a really good understanding of why the Stacks token exists, right? For example, Lightning doesn't have its own token, so why does Stacks need its own token? All right, so let's start off with scaling solutions more broadly, right? So there are 2 main ways to scale a blockchain. There's on-chain and off-chain. Now, on-chain scaling, so this is also known as a layer 1 scaling solution. So here you're making changes to the blockchain mainnet itself in order to scale it. Now, examples of layer 1 scaling solutions include sharding, right? Where you chop up the network into small bits, and different teams of validators essentially handle each of them. Now, you might have heard of sharding in the context of Ethereum 2.0. Now, another example of on-chain scaling are block size changes, right? So if you make every block on the blockchain a bit bigger, then you can pack in more transactions every block. Now, this is what Bitcoin Cash did. The problem with making blocks bigger is you tend to squeeze out the smaller miners who can't afford the high computing power in order to continue participating in the network. And this ultimately makes the blockchain a little less decentralized. You end up with a network with hash power concentrated in fewer and larger miners. Okay, finally, layer 1 scaling solutions. You've got changing the consensus algorithm behind the blockchain itself, right? Such as optimizing how blocks are created and validated and how the network communicates as a whole, in that effort to squeeze out more transactions per second, which gets you that throughput that you desire. Now, the daddy example of switching up consensus is, I guess, Ethereum completing its move from proof of work consensus to proof of stake in its Shanghai upgrade. All right, so that's on-chain scaling, otherwise known as layer 1 scaling. Moving now to off-chain scaling solutions. So here, no changes need to be made to the base layer, and instead you basically distribute the transactions off the base chain, hence the name off-chain scaling, onto another chain for processing, and this helps take traffic off the base chain and alleviate congestion. Now, off-chain solutions, they can be broken up into 2 types. You've got layer 2s, right? And you've got what people nowadays call new chain creation. So hopping onto layer 2s for a second, layer 2s, they rely on the security of the base layer, right? In other words, L2s, they leverage the consensus mechanism of the base layer to settle transactions. As a consequence of this is layer 2s can't really exist without the base layer. Now, examples of L2s on Ethereum include Arbitrum and Optimism. And this combo of the base layer that focuses on security and decentralization, along with the L2 sitting on top that scales that base chain, relying on the base chain security, that's been a pretty common combination of L1, L2 so far over the past 5 years. All right, so that's L2s. What about new chain creation? What did I mean by that? So that's the other type of off-chain scaling solution. Now, this refers to solutions where security isn't derived from the base chain, right? The most well-known example is, well, just an ordinary vanilla sidechain, a whole new blockchain that's sitting essentially alongside the base layer with its own independent consensus mechanism that doesn't rely on the security of the base layer. Now, on Ethereum, the best example is Polygon Proof of Stake, whose native token is Matic. But other new chain creation solutions include Validiums and Plasma chains, which I won't go into any detail in this particular video. Now, moving back onto sidechains for a little bit, since sidechains are whole sovereign chains themselves, there are some benefits to that. They can stay running even if the base layer has an outage. But one of the downsides of not bandwagoning on the base chain for security is that sometimes sidechains do end up a little bit more centralized, and this is a critique Polygon has gotten in the past. All right, so summing up, you've got on-chain scaling, which tweaks the base chain itself to make it churn faster through more transactions. And you've got off-chain scaling, which offload traffic onto another chain, right? And these are usually either side chains or L2s, layer 2s. Now, L2s themselves, they fall under a couple of main types. So number one, you've got staked channels, where multiple transactions are executed without recording every single transaction on the blockchain, right? You only record, turns out, the opening and the closing balances, right? Which reduces the on-chain load. Now, this is how the Bitcoin Lightning Network works. And then you got rollups, right? Which add multiple transactions into a single transaction, or rollup, as they're called. And that's then submitted to the base layer for settlement. Now, rollups are becoming more and more mature. It's becoming a fairly mature scene on Ethereum, but it is still very experimental on Bitcoin. So I'll focus more on what's happening on Ethereum. So on ETH, you've got optimistic rollups and you've got ZK rollups, right? So examples of optimistic rollups include Optimism and Arbitrum 1. And these chains, I guess you can say, optimistically assume that the transactions being processed are valid until proven otherwise, which helps throughput. It's kind of like security at a venue that's very optimistic with its vetting. Now, the downside of optimistic rollups is finality, right? How long it takes for transactions to be confirmed. So for example, on Optimism, you got to wait 7 days for the chain to finalize transactions and double check that your transactions are indeed valid. Now, more generally, this challenge period on optimistic rollups can range from 3 days all the way up to 14 days, a whole fortnight, which can make withdrawals of assets from an L2 back to the base layer a little bit problematic, especially for NFTs, where there's just no way to bypass this waiting period. Now, an example of a ZK rollup is Polygon ZK EVM, where validators have to provide proofs that the transactions themselves are valid. Now, the benefit with ZK rollups is you can get instant finality, right? Because all that security due diligence is being done on the spot, right? Making ZK rollups the gold standard for certain use cases such as Web3 gaming, where quick finality is very important. Actually, indeed, Immutable X, a layer 2 that's designed specifically for gaming, that is a ZK rollup. All right, so with all of this said, let's try and answer the question, what exactly is Stacks in the grand scheme of things? Is it an L2? Is it a side chain? Is it actually a layer 1? And you're going to get a lot of mixed answers to this on the internet. Here, I'm going to bring something up that's from the Stacks documentation. And the answer is complicated, and I'll break the reasons down into 3 categories, I guess you can say. So firstly, people have different definitions of what an L2 means, right, versus sidechains. So some people consider sidechains to be a type of L2, some don't. And in the explanation I gave earlier, I assume that L2s and sidechains were different. But there tends to be universal agreement that L2s can't exist without the underlying L1, because L2s use the security of the base layer, which makes them dependent on the consensus mechanism of the L1 to function. So to put that another way, L1s are sovereign chains. They have their own security budget, and L2s don't. Now here's the interesting bit regarding Stacks. The initial version of Stacks, the blockchain, released in 2021, had its own security budget, which makes it more of an L1, right? Well, at least a side chain, right? But Stacks couldn't actually function without the Bitcoin chain either, which then makes it kind of like an L2, right? So you can see how this gets a bit complicated. And a Decrypt interview in 2021, in that interview, Munib Ali called Stacks a layer 1.5. right? Something bang in the middle. Now, a second complication is that Ethereum L2s work a little bit differently to Bitcoin L2s. The definition that Ethereum folks focus on is the ability to withdraw assets using only L1 security and L1 validators. But Stacks, on Stacks, a set of peg-out signers determine whether you can move your L2 assets back to the base layer. So that actually means Stacks wouldn't be an L2 in the Ethereum L2 sense. Finally, a third complication is the Stacks chain itself is evolving over time, right? Actually making it more and more L2-like over time. Stacks will no longer have its own security budget after the Nakamoto hard fork, making it like an L2. Stacks will be well and truly anchored to Bitcoin, and 100% of Bitcoin hash power is going to determine finality for Bitcoin blocks heading into the future, which really makes Stacks sound like an L2. And this is great news because, as I mentioned earlier, reversing Stacks transactions is going to be as difficult as reversing Bitcoin transactions, which is very unlikely, right? It's a very secure network. If you want to commandeer and reorganize the Stacks blockchain, you're essentially going to have to reorganize the Bitcoin blockchain, which is, just too darn enormously difficult given how secure Bitcoin is. So in summary, is Stacks a Bitcoin L2? Well, as it stands right now, you can make arguments that Stacks isn't a sidechain, right? You can make arguments that it's not an Ethereum-like L2 either, although it will soon become more like an L2 after the Nakamoto update, but not in the Ethereum sense. Look, you can see how confusing all of this is, which is why the Stacks team likes to refer to Stacks simply as a Bitcoin layer, right? Which captures the idea that of any layer sitting on top of or next to Bitcoin. And they don't mind people using Bitcoin L2 just to keep things simple, because the idea of a Bitcoin L2 does make the distinction against an Ethereum L2. All right, look, I think you're probably sick of me harking on about L1s, L2s, and sidechains. So we'll wrap things up on scaling solutions by comparing Stacks to other top L2s on Bitcoin L2s. So first up is the one that people arguably are most familiar with, which is the Bitcoin Lightning Network. Right? How does that compare with Stacks? So more people, I think more people have probably heard of Lightning, to be honest, more than Stacks, because Lightning is something that I think it generated a lot of media publicity back when it came out, and people often don't associate smart contracts with Bitcoin, let's be honest, right? But hopefully that things will change with Stacks getting more traction, especially after the sBTC and Nakamoto updates. Okay, so straight off the bat, I want to stress that Lightning Network and Stacks, they're not really competitors, right? Unlike L2s on Ethereum, I think Arbitrum, think Optimism, think Polygon, peer competitors who are generally trying to do similar things, which is ultimately scaling, where they're all competing for a similar user base and win the scaling wars with the best technology. The L2/sidechain, whatever you want to call it, scene is a bit different on Bitcoin, right? Now, to put it simply, Lightning is for payments, while Stacks is about advanced smart contracts. It's about DeFi, it's about Web3. Now, Lightning is an L2 state channel, which means a whole bunch of transactions are executed off-chain, and you only record the opening and the closing balances, right? Not the stuff in between. So Lightning is extremely quick, right? It's great for scaling Bitcoin for payments because you do a whole flurry of transactions and only the final result needs to be sent back to Bitcoin for settlement. Now, to paint the difference in a slightly different way, there's no state management on Lightning, right? There's no continuous record of what happens on the network, only the current channels. So once users close their channel and their transactions are written back to Bitcoin, information about all these intermediate transactions are essentially gone, they're erased. Meanwhile, Stacks is working on a fully expressive smart contracts platform, right, where there's a historical record of every transaction. So ultimately, Lightning is all about scaling Bitcoin, right, about making existing Bitcoin functionality faster. It's ideal for payments, right, and other use cases like Web3 gaming. Meanwhile, Stacks is trying to solve really a completely different problem, which is expanding Bitcoin's functionality and making it do things that it currently can't. All right, next up, what's the difference between Rootstack or RSK versus Stacks? Well, like Stacks, Rootstack improves Bitcoin's functionality with smart contracts, right, which opens the door to DeFi. The Stacks and RSK diverge quite a lot on how they plan to do things, how they go about implementing all of this. So Rootstack is a layer 2 that's actually based on the Ethereum virtual machine. Right, so a lot of Rootstack is actually about bringing EVM compatibility to Bitcoin DeFi. The consensus mechanism is also quite different between the two chains. RSK uses something called merge mining. Now this is a proof of work technique where Rootstack miners simultaneously mine both Bitcoin and RSK using the same hashing algorithm and sharing the same computational power. Right? It's quite interesting. The block times are about 30 seconds and throughput is about 10 to 20 TPS, right? So it's faster than Bitcoin. Now, in a nutshell, Rootstack, it connects the Ethereum world to Bitcoin. I guess you can say that. You can execute Ethereum smart contracts on Rootstack because of its EVM compatibility. Rootstack developers, they can code using Solidity, while Stacks is quite clear cut about forging its own destiny with Clarity and Clarity VM. Now, similar to sBTC on Stacks, there's a token on Rootstack called RBTC, right? That's pegged one-to-one to Bitcoin. And that enables users to lock up their Bitcoin on the base layer, and you can then mint an equivalent amount of RBTC for transactions on the Rootstack chain. Next up, Liquid Network versus Stacks. So Liquid, it's a side chain that's focused on building financial infrastructure for Bitcoin, right? Ranging from security tokens to stable coins. So in that respect, it's kind of like Lightning, but Liquid doesn't really support more general purpose use cases, unlike Stacks and Rootstack with their smart contract capabilities. Now, performance-wise, you're looking at a 60-second block time with 2-block finality, right, which is quite a lot faster than Bitcoin, which is needed for Liquid's goals of enabling issuing and settling financial transactions, financial assets on Bitcoin. Now, similar to Stacks and Rootstack, you can bridge assets between Liquid and Bitcoin using an asset, LBTC, that's pegged one-to-one with Bitcoin. Now, one notable thing is that a Liquid is quite centralized, right? Something that's not uncommon with sidechains, but Liquid uses something called strong federation as its consensus mechanism. Now, this relies on a subset of its members called functionaries, which are these are basically crypto native organizations. Relies on these organizations to validate transactions. Now, this helps blockchain performance, but at the expense of decentralization. One final thing that I will mention is that Liquid is developed by a company called Blockstream, and this is actually a company founded by Adam Beck, one of the candidates for Satoshi Nakamoto himself, which is pretty interesting. So in a nutshell, Liquid is building financial infrastructure on top of Bitcoin. It's faster than Bitcoin, but also more centralized. Stacks, meanwhile, focuses on advanced smart contracts, and as it's continuing developing innovations like sBTC, it's trying to keep things as decentralized as possible, and leveraging security and consensus of Bitcoin as much as possible. All right, we now have a really good idea of how Stacks works, where the project is going, and how it compares to other L2s. Now, I want to talk about a question that often isn't asked enough. Does a blockchain project, so in this case Stacks, really need its own token, right? Is STX really necessary, right? Because Lightning doesn't have its own token, so why does Stacks need its own token? Now, Bitcoin maxis, they often rail against altcoins and the VCs behind them and the conflict of interests that might result. And to be fair, we've seen quite a lot of altcoin and Web3 projects force the use of a token when it's not really needed, right? Meanwhile, Bitcoin builders, they have a history of building apps and protocols on the base layer without the need for tokens. So the question is, does Stacks need a token, right? Or did it force one into the ecosystem during the ICO era, maybe because it needed to raise money and all the VCs that backed it needed to make money, right? And I'm glad to say that the short answer is, well, yes, for what the team wanted to do, it needed a token. And it's for two main reasons. Number one, the Stacks token is needed to incentivize its miners. Right, that's reason number one. And number two, going into the future, a token is needed to provide incentives for the sBTC peg out signers. Now, if you're wondering why these incentives are needed to keep the Stacks running, we need to zoom out a bit and ask ourselves, why do crypto projects need tokens in the first place? And the answer is to fund the maintenance of the project and to advance the progress of the project, right? Bitcoin, it exists to incentivize miners to add new blocks to the chain. Otherwise, what's the incentive for miners to spend their hard-earned money on electricity, on computing power to solve cryptographic puzzles, right? They need to be rewarded for their work. That's the incentive structure that attracts miners to keep churning out blocks and maintain the network, right? So for L1s and sidechain projects, tokens basically exist as an incentive mechanism to secure the chain. And that's exactly why Lightning, it doesn't need a token and it doesn't have one, right? Blockchains are decentralized ledgers and Lightning doesn't need to maintain a historical record of all of the transactions, as opposed to Stacks, which is trying to build a decentralized economy on top of Bitcoin, powered by powerful, fully expressive smart contracts, right? Which does need that history. Unlike a state channel, which to simply make Bitcoin run faster, which is what Lightning is, Stacks need to do things like maintain that complete historical record of every transaction, right? It's a lot of work, a good amount of upkeep, so it's necessary for the maintenance of Stacks to be incentivized correctly. At least that's the argument that the Stacks team makes. In fact, the Stacks team argues that the only way to remove the token is to build Stacks as a federated network like Liquid, right? Where basically a group of companies control the mining and they need to be trusted for peg out transactions. And we know that that's diametrically opposed to what Stacks is trying to build, which is number one, an open and decentralized network where anyone can come and participate. And number two, the peg in and peg out transactions, they have to be decentralized, right? As opposed to being processed by some centralized federation, right? And so this requires economic incentives to ensure, in particular, peg out signers behave correctly, which is what Stacks does through its stacking mechanism and sBTC. All right, long video so far. Before I wrap things up about Stacks and go into the price predictions, let's talk about Stacks, what it is in a nutshell. Stacks and Bitcoin, they complement each other, right? It's like the best parts of Bitcoin, but better, more powerful, more functional. Stacks leverages the extreme decentralization of Bitcoin, right? It leverages its proof of work consensus. It leverages its value as a cryptocurrency as a solid foundation to expand the capabilities of Bitcoin and unlock additional use cases, helping to increase Bitcoin's utility and hence value over time. So to put it another way, Bitcoin, it has a whopping $1 trillion valuation, right? Market cap. The biggest in crypto, but it's failed so far to be a productive asset. For example, just looking at DeFi, there's such a high valuation for Bitcoin as a token, yet so proportionally little of that value is being used and locked up in DeFi apps compared to Ethereum and other chains. Now, Stacks aims to change all of this by building the infrastructure and the tools to unlock all $1 trillion worth of Bitcoin for productive use. Now, a byproduct of this is Stacks is also supporting the long-term viability of the Bitcoin network as a whole, which is the challenge of whether or not Bitcoin can survive once all the Bitcoin has been mined, right? A long-standing problem, right? Once all of the Coinbase rewards are gone and the network has to survive on transaction fees alone. If Bitcoin's only use ends up being a store of value, there's going to be a limit on the value that's being exchanged on the network, right? But if Stacks can use Bitcoin as a foundation for for a vibrant global decentralized economy, then transactions on Bitcoin will really come alive, right? And this will increase the transaction fees, which provides ongoing incentives for miners to continuing wanting to secure the network after the Coinbase rewards have all dried up. So all up, Stacks is, in my opinion at least, the most compelling and complete icing on the cake of Bitcoin that I've personally ever seen. Right, now before I dive into some price predictions, I want to talk briefly about why I believe Stacks is a prudent investment of the times, not financial advice of course. And the short answer is, you want to pick projects that can outpace the blue chip cryptocurrencies over the next couple of years, while hedging against an uncertain macro environment. And I expect that there are very few projects out there that can do this with good confidence, but Stacks looks to be one of them. So let me dive in a little bit further. Right now, the macro, it doesn't look great. There's a lot of uncertainty. Right, in 2022, we came off the back of a decade-long secular bull market of easy monetary policy that inflated asset prices, especially during the COVID pandemic. Inflation, it skyrocketed. Central banks began aggressively hiking rates, spearheaded by the US Federal Reserve, that jacked up the federal funds rate a whopping 11 times in 16 months in a bid to curb runaway inflation, while withdrawing excess liquidity from the system, right, reducing its balance sheets. All of this is the kind of behavior that is not friendly towards assets, right? And it's not over. We just printed our highest month-to-month inflation since September 2023 at 0.3%. And if we hold at this pace, you're looking at an annualized print of up to 3.6%. And that's not what the Fed wants to see. That's not what Papa Powell wants to see, right? Its mandate is to achieve price stability, get that year-on-year inflation down to 2% and hold it there. And the data is showing that we've got a while to go. Looking at global liquidity, right? It continues to trend downwards, right? As central banks unwind all of that easy money, all of that quantitative easing, all that money printing. We're now in a phase of tightening, aimed to reduce these balance sheets, removing excess money from the system, which historically, well, what's it going to do? It's going to deflate asset prices. The yield curve, right? One of the most reliable recession indicators that economists rely on, is now uninverting. Now, historically, this means that the stock market usually dumps one last time. The longer central banks are forced to hold rates high, the stronger the chances of something breaking either in the economy or in our financial system that forces them to begin cutting rates, and which has, again, looking at past data, caused the final dump in prices in the stock market. Now, if you're new to macroeconomics as a crypto investor, feel free to check out my guide, which I'll link down in below. So here I talk about economic cycles, different types of assets and which ones are most attractive at different times, monetary policies, how the bond markets relate to crypto, and so on. And look, the bottom line is this is the first time in history that in our 15-year-old crypto market, we're trying to flourish without central bank support, right? Rates are high. Liquidity is evaporating. Equities, i.e. the stock market, has mainly been pumping off the back of a small number of big tech companies like Nvidia, that's leading the way with generative AI hardware. But there's only so much stock price increase that the already sky-high forward earnings projections can sustain. So in other words, things could go higher, but don't be surprised if the party's winding down. So that's the stock market. What about crypto? Well, crypto's saving grace really has been the Bitcoin ETFs, right? Ever since the SEC finally approved spot Bitcoin ETFs, huge news may I add, right? That opens the tiny 1 to 2 trillion crypto market to the 50 trillion stock market. Well, after an initially disappointing couple of weeks of inflows that mainly saw liquidity jump ship from grayscale over to the new spot ETFs, we finally began seeing large inflows of money coming from the outside, right? This buy side pressure sustaining Bitcoin's price appreciation. Now, right now, the narrative is undoubtedly Bitcoin. And while the broader macro picture looks a bit hazy going forward, it means being in picks and shovels investments, being in infrastructure investments for Bitcoin is one of the best ways to, number one, ride that Bitcoin narrative. Number two, perhaps outperform Bitcoin itself. And number three, hopefully hedge yourself against that unclear macro picture. And that's what makes Stacks so especially relevant right now, right? Even though I think that Stacks is always kind of relevant because Bitcoin is always relevant. Right now, with the global macro and geopolitical environment a bit hazy, and crypto's only major narrative right now being the spot ETF inflows, if you're going to have your money parked in an altcoin, then top-notch Bitcoin infrastructure plays like Stacks is something that appeals to a lot of investors, where you can outperform Bitcoin during the good times and possibly keep pace with Bitcoin during the pullbacks. And so that's the investor's argument for Stacks right now. Not financial advice, of course. I'm not telling anyone to buy anything. I'm just sharing what I know about different crypto and Web3 projects. All right, last part of the video, probably what you're all waiting for, the price predictions. Now, I'm going to show you some tables, diagrams, and numbers, and they're all going to be in this article here that I published on my blog. Feel free to check that out. Now, before I dive in, just bear in mind that crypto predictions are wildly speculative, right? We don't have traditional methods of valuation and prediction that the stock market has, right? Such as the discounted cash flow model, P ratios, PB ratios, PEG, and so on, right? We've got fuzzy metrics like network effect, hash rate, number of dApps, right? Developer activity, things that are more loose when it comes to determining the value of a crypto asset. So what I'm trying to say is please don't take any of what I'm about to say to the bank, right? I'm going to show you some projections based on what I consider reasonable and simple metrics, market cap, price ratios, and relative market dominance, which can give you an idea of what's possible when it comes to price. All right, first up, market cap, a basic staple tool for valuing crypto prices by looking at the combined amount of money that's sitting in a crypto asset. So looking at this table here, the first row is where we are currently, and going from left to right, the columns are the total crypto market cap, right? Basically the value of all the money that's parked in all the crypto tokens. And then we've got the Bitcoin market cap, right? An important metric given that Stacks is an infrastructure project for Bitcoin. And so it makes sense that its fate is somewhat anchored to that of Bitcoin. And then we've got the numbers for Stacks itself, right? The STX token. Now, at the time that I made these tables, which was a few days ago, the Stacks price was about $2.50. And given the current momentum in the market, there is every chance that the price is higher right now as you're watching this. Now, the next three rows, right, these are projections based on past historical milestones. And the benchmark I'm using is Polygon. It's based on Polygon, right, in the last market cycle bull run. Because back then, this was the leading scaling solution for Ethereum, right, the leading smart contracts platform. So we're going to bandwagon on Polygon's performance as an L2/sidechain for Ethereum in the last bull run as a reference point to make some fun projections for Stacks and Bitcoin. Okay, now in the first row, right, we're focusing on the all-time high for Polygon Matic back in December 2021, when Matic hit a valuation of 20 billion, right, which was a month after November, right, Bitcoin's own 69K peak. Now, the projection is if STX, right, if Stacks can hit the same market cap of 20 billion, then you're looking at a $14 Stacks token, right, which is about a 5 to 6x from here, from the price of Stacks being $2.50. And so bearing in mind, if you're watching this and Stacks is now higher, right, if it's hit $3, $4 or higher, you're going to need to temper your expectations accordingly. Or maybe you're watching this right now and the Bitcoin ETF inflows have stalled. Maybe the macro picture isn't looking so good and Stacks has pulled back below $2.50. In that case, the upside is a bit higher, according to these projections. All right, moving on. The next row is a bit of a more nuanced take on Matic's valuation, right? Looking at when Matic peaked against Ethereum as a reference point. Now, it turns out in early November 2021, Matic achieved a relative 4% market dominance versus Ether. So that's basically another way of saying that the market cap of Matic hit an all-time high of 4% of Ethereum's market cap, right, at that time. And highlighting a point in time, you can argue that the momentum for Polygon adoption, and so on, for Ethereum users was running hot. The projection is then, if Stacks could achieve a market cap that's 4% of Bitcoins, right? That's the premise here. And assuming that Bitcoin returns to an all-time high of 69K, which really isn't that far away, if I'm going to be honest, right? I made these tables a few days ago. Bitcoin was 51K. Right now it's 61K, right? We're 8 grand away from all-time highs, not that far away. If that's true, if that comes true, then Stacks would hit a 52 billion valuation, right? Which will translate to roughly $36, right? A $36 Stacks token, which would be roughly 14x from where we are today, assuming Stacks is $2.50. Okay, and then looking even further into the future, right? So here we're looking at potentially a post-halving market cycle bull run, right? The premise here is if Bitcoin hits 100K, right, its market cap would be about 2 trillion, right? So this could happen post-halving bull run, or it could happen even sooner. Maybe there's a huge onslaught of liquidity continuing to flow into the Bitcoin spot ETFs, and we just get a crazy bull run earlier 2024, right? Under these assumptions, let's say Bitcoin goes to 100K, right? And we assume that Stacks have had its sBTC, its Nakamoto upgrades, and DeFi on Bitcoin might be taking off. Everything's going great. And Stacks grows its market cap to 5% of Bitcoins, right? When Bitcoin is at 100K. Then if you crunch the numbers, right, you're looking at roughly a $60 to $70 to $80 Stacks, which works out to be 25, 30, 35x from where we are today. Interesting stuff. Again, don't take any of this to the bank. I just want to give you an idea of what's possible under different market conditions. All right, next up, analysis based on price ratios. So here, the obvious focus is Stacks against Bitcoin. Now, if you haven't seen price ratios before, investors and traders use them all the time. The most popular, well, I guess, popular and common price ratio in crypto is the ETH to BTC ratio, right? The price of Ether divided by the price of Bitcoin. So here, when this chart is going up, right, here in 2017 and here in 2020, 2021, what that says is Ether is outperforming Bitcoin, right? Either because Ethereum's price is rising quicker than Bitcoin's, or it's bleeding slower than Bitcoin's. So a common scenario is that this happens is during a bull run, as investors and traders take on more of a risk-on profile and rotate Bitcoin profits into Ethereum, and then later down the track into riskier alts. And when this chart is going down here and this slower bleed here, that means the price of ETH is bleeding against the price of Bitcoin, right? Which tends to happen during bear markets as investors go risk off and they try to seek refuge into safe haven assets. That includes Bitcoin and stable coins, even bonds, as has been the case these couple of years due to some precarious macro conditions. All right, so back to our tables. Right, so here we have the price ratios with Stacks against Bitcoin, some projections here. So looking at this table, the first row is where we are today, right? So at the time that this table was made, the total crypto market cap was almost 2 trillion. The price of Bitcoin was 51K. I know it's currently 61K, right? Things are happening very quick. And the stacks to BTC ratio, with the price of stacks being $2.50 and Bitcoin being 51K, ends up being this number here, right? And again, this is the number you get from dividing the price of stacks by the price of Bitcoin. The next 3 rows are, as usual, our projections. So here I've presented 3 scenarios: normal, bullish, bearish. Let's go through them. So in the normal scenario, I assume that we return back to the 2021 bull run peak. So there, the whole market hit roughly a 3 trillion valuation. Bitcoin hit 69K, which we're not that far away from again. And I assume that if Bitcoin returns to this price, then Stacks, which has been pumping pretty hard against Bitcoin already. So if we go back to the charts here, Stacks against Bitcoin, right? Look at this huge rally against Bitcoin, beginning ever since the anticipation of the spot Bitcoin ETFs in early Q4 2023, which is when Bitcoin kicked off its own huge rally, all the way to the SEC approval announcement in early January, and then continuing to outperform Bitcoin as Bitcoin continued to rally off the spot ETF inflows throughout Q1 2024. So if this trend keeps going and Bitcoin hits all-time highs off the back of this liquidity, either soon or later, or maybe there's a bit of a cool down period, and then Bitcoin continues to rally later down the year to that all-time high. So I assume in this situation that Stacks could continue to outperform Bitcoin maybe by a factor of 2, right? Stacks' price appreciates twice as quick as Bitcoin's. And in a scenario like this, the price ratio would therefore double, and then this would translate to a price of roughly $7 for Stacks, which would be a 2 to 3x from where we are today. All right, moving on to the bullish case, where I assume we hit the original projection that many investors expected or had hoped that the 2021 bull run would hit, right? Where the whole market basically reaches a 10 trillion market cap, 10 trillion valuation, where Bitcoin goes into the double-digit range, price range, between 100 to 300K. So here I've chosen 200, middle of the road figure. And in this situation, I assume that Bitcoin holds a steady market dominance of roughly 40 to 50% right now. And for Stacks, being an altcoin with a market cap that is 3 orders of magnitude smaller than Bitcoin's, of course, I'm going to assume that Stacks continues to outperform Bitcoin, right? As Bitcoin rallies towards 200K, Stacks is going to rally even faster. And when we reach that blow off top, I assume that Stacks ends up doing a 6x against Bitcoin from where we are today, right? So if you multiply this price ratio by roughly 6, you get this price ratio here. I think it's totally possible because we are talking about a complete melt your face off bull market. Anyway, in this situation, Stacks, you're looking at a roughly 80 billion market cap, which would translate to a roughly $50, $60, $70, right? Which would be 15, 20, 25x from where we are today. All right, finally, the bearish case. Right, so here I assume that the currently precarious, uncertain macro conditions eventuate into a recession, right? Which is historically what reliable macro indicators like the bond yield curve is hinting. So in this situation, I assume the whole market dives back down to $1 trillion or below. Under this situation, it wouldn't be too surprising if Bitcoin dives below 30K again. And the broader altcoin space is most likely going to plummet, right, as investor sentiment turn risk off. And I assume that Stacks bleeds roughly 60-70% against Bitcoin from where we are today. So basically this price ratio, I've taken a third of that in this projection. right? And in a situation like that, the market cap of stats dives below $1 billion, right? It goes from, stacks will go from being a mid cap down to a small cap again. And with a 650 million valuation, you're looking at a 50-cent stacks token, right? Which would translate to roughly an 80% drawdown from where we are today. All right, so 3 different projections, right? I wanted to give a broad range of different projections under different market scenarios. And I think the main takeaway here is looking at these numbers, which I didn't just pluck out of a hat, but try to make some arguments for. Anything can happen, right? If times are good, your investment can really fly. If things go the other way, you're ultimately holding an altcoin. Stacks is still ultimately an altcoin, albeit a very good one in my opinion. It's a risk on asset that people will be dumping for Bitcoin, stables, USD. So look, anything can happen. Okay, final approach is using what's called relative market dominance, which mathematically ends up working out pretty similar to the price ratio approach we looked at just then. Instead of looking at the ratio of token prices, you're basically taking ratios of the market caps instead. And so mathematically, you're really off by just the circulating supplies. If you have 2 tokens and the circulating supplies don't change at all, you'll basically end up with the exact same graphs, right? Now, the benefit of using relative market dominance is that on the charts, the numbers you get, right, the numbers are very intuitive to understand. So if I illustrate with Ethereum versus Bitcoin once again, right, so here we're back looking at the Ethereum to BTC price ratio before. If I tell you, for example, that during the 2017 bull run, the ETH to BTC price ratio hit 0.15, right? Then by itself, that data point, it doesn't mean much. It's just an abstract number, right? Which I happen to get by dividing the price of Ether by the price of Bitcoin. The usefulness of this chart really comes from tracking changes over time. So for example, if it's trending upwards here and here, right? That means Ether is outperforming Bitcoin during those times. And if it's exploding like it did here during the 2017 run up to the blow off top, that means that Ether might be overbought against Bitcoin. You might want to rotate some profits from Ethereum to Bitcoin during this time here, right? So that's the usefulness of this price ratio chart here, right? It's really for tracking changes over time. But now if I flick over to this chart, which is actually a pretty similar picture, the ETH to BTC relative market dominance, which you can get in 2 ways, right? You can either divide Ethereum's market cap by Bitcoin's market cap, or if you can't find that on TradingView, you can divide Ethereum's market dominance by Bitcoin's market dominance. Mathematically, you get the same thing. You actually get a very similar picture to before. Again, it's only different because of the circulating supplies that have changed, right? But now the outcome of this chart is that I can interpret what's going on a lot easier and at any point in isolation, any point in time in isolation as well. So for example, right now, the relative market dominance is 33%, right? And that's telling me that Ether's valuation, right, the market cap of Ethereum is currently 33% the market cap of Bitcoin's. It's a very interpretable number, right? And going back to the 2017 blow off top example, from this chart, I can tell you that the relative market dominance of ETH versus Bitcoin hit 67%. And this time round, this is not some abstract number. This is telling me the market cap of Ethereum hit 67% or 2/3 of Bitcoins during the blow off top period in 2017. So this is something quite easy to understand. And then taking this even further, we know that if this chart hits 100%, that means the flippening, right? Ethereum flips Bitcoin, right? The long-awaited flippening, where Ethereum's market cap finally hits and flips Bitcoin's market cap, right? Very interpretable numbers from this chart here. That's the main benefit of looking at relative market dominance. As for the flippening, hey, look, hey, it's going to happen, right? Well, who knows? If Stacks' DeFi scene and Web3 scene really takes off and attracts a ton of interest and liquidity, maybe not, right? Who knows? We'll see. All right, so let's apply all of this to Stacks and check out some projections for relative market dominance. All right, so the first row is where we are at the time that I made these tables a few days ago. Right, so Bitcoin was at 51K. I know it's 61K right now. Things, again, progress really fast. So its market cap was about $1 trillion back then. If you divide that by the total crypto market cap at the time, right, that translates to 54% market dominance for Bitcoin. Right. In other words, 54% of money in crypto a few days ago was sitting in Bitcoin. We know Stacks' market cap was about 3.6 billion, right? Basically between 3 to 4 billion, pretty small compared to Bitcoin's. So 3.6 billion divided by 1 trillion, right? Stacks' market cap divided by Bitcoin's market cap. That gives you a relative market dominance of 0.35%. In other words, the market cap of Stacks is just 0.35% of Bitcoin's. All right, now we move on to our projections. And we have the normal, bullish, and bearish scenarios, which correspond to the same price ratio market conditions as earlier, right? So in the normal case, just like before, we assume that the crypto market cap for Bitcoin hits the 2021 bull run peak. And that means Bitcoin's market cap returns back to 1.35 trillion, right? Which is what it hit when Bitcoin hit 69K. We'll have to do a little bit of an adjustment because the circulating supply has changed for Bitcoin. It's gone up a little bit, but I'm going to negate that small variation just to keep things simple. All right, and then I'm going to assume that the Stacks valuation, right, the market cap, increases at a pace that's double that of Bitcoin's. Again, a similar argument to the normal case for the price ratios earlier. And so that means the relative market dominance of Stacks against Bitcoin is going to double from 0.35% to 0.7%. So in that scenario, what I'm basically saying is that in this normal scenario where Bitcoin goes back to all-time highs, we assume that 0.7% of Bitcoin's 1.5 trillion market cap, right, that's going to be the market cap of Stacks. And so that's going to translate to roughly a $10 billion Stacks token, which equates to roughly $67 per Stacks token, right? Which is around 2 to 3x from where we are today. Again, similar outcome to the normal scenario for the price ratios. Okay, looking at the bull case, and again, I think things are going to work out pretty similar to the price ratios example earlier. So here, the whole market goes to $10 trillion, like we assumed before. And here I assume that the Stacks valuation increases at a pace 6 times quicker than Bitcoin's. Again, same assumption as the normal case for the price ratios. And again, fair enough, I think, given that the Stacks market cap is a tiny fraction of Bitcoin's market cap, right? So there's a lot more potential. And then there's the additional possibility that in this bullish scenario where Bitcoin goes that high, right, it could take a year, another 2 years for that to happen, right? Perhaps after the upcoming halving, there's every opportunity that Stacks' DeFi, NFTs, and Web3 ecosystem really hits off, right? Starts firing on all cylinders after the sBTC and Nakamoto upgrades, right? So in this scenario, we assume that the valuation, right, the market cap of Stacks, it really ramps up quickly, gets a lot of new liquidity, right? And Stacks' relative market dominance hits 2%. That would equate to a $80 billion Stacks token, right? Which equates to about $50, $50, $60, $70, or a 20x from here. Right, again, similar outcome to the bullish price ratio scenario from earlier, and not really surprising because again, the market conditions we assume to be the same, and mathematically, when you argue using relative market dominance, it is pretty similar to using price ratios, especially when the circulating supplies don't vary that much. All right, finally, in the bear case, corresponding to that recessionary macro environment, right? Or maybe some sort of a really bad black swan event for crypto. I assume the markets dive down to 1 trillion. Bitcoin goes sub 30K again, right? Which translates to a market cap of around 600 billion or less. And in this situation, right, quite bearish, I assume just like a lot of alts, Stacks is going to bleed against the safe haven assets. So I assume Stacks bleeds 60 to 70% against Bitcoin, right? As liquidity flies to safety, right? Giving us that sub 1 billion Stacks once again. And with a 700 million market cap, that translates to a Stacks token price of around 50 cents, right? Which is about an 80% dump. Very similar outcome to the bearish case for the price ratios situation. Again, not surprising because the argument is very similar. Relative market dominance versus the ratio of the prices. The only mathematical difference is circulating supplies fluctuating, right? So if you assume the same market conditions and the circulating supplies don't change that by much, the numbers here end up working out to be quite similar. Okay, in summary, 3 projections. One that is quite bullish, one that is quite bearish, and something in between, right? The Goldilocks one to keep everyone happy. And as you can see, the possibilities are quite wide, right? Which is why these projections are really here to show off what's possible. You know, don't take any of this to the bank. All right, I think I'm gonna leave it here. This might have just been the longest video I've ever made. If you found this content useful, please help me out. Hit that like button and drop a comment. This video took me, I think, 2.5 weeks to put together. So do let me know what you thought of it. Any other projects you'd like me to dive into. And if you enjoy the content, please consider subscribing if you haven't. Stay safe, keep learning, and always watch your risk. See you next time.